Have you ever wished you just had a shortcut, like a direct line to understanding what might happen next with something huge like Bitcoin, cutting through all the noise? Well, today, that's pretty much what we're aiming for. We're going to dig into an AI-generated 30-day Bitcoin price forecast, specifically for July 17th, 2025, running through to August 16th, 2025. Our goal here is really to pull out the most important bits from this advanced deep learning by AI forecast report. We want to understand what it's really telling us, and maybe more importantly, what you should think about when you see these kinds of predictions.
Yeah, and right off the bat, this AI, it's painting a picture of a gradual climb for Bitcoin, but importantly with what it calls mild volatility.
Mm-hmm.
So it sees things starting around, let's say, $118,170 for the daily close,
Yeah.
maybe peaking near $128,840.
Okay, $120,840 peak.
Exactly. And what's interesting is that's roughly a 9% increase from the price when the report was generated. But, and this is key, all these numbers, they come with this plus or minus 5% confidence interval.
Right, the margin of error.
Precisely. It's like a buffer. It acknowledges that the real price can wiggle around a bit because, well, markets fluctuate. It's just built-in realism.
Okay, let's unpack this a bit more then. The AI mentions moderate confidence in this upward trend. What does that actually signal about, like, the market's direction and maybe its underlying strength for these 30 days?
Well, moderate confidence here isn't suggesting, things going absolutely parabolic. It's more like a signal of a pretty robust, steady accumulation phase. It gets that confidence from looking at things like the 24-hour trading volume, which is huge, almost $69 billion, and Bitcoin's dominance, still over 61%.
Okay.
So those numbers point to solid positive momentum. But the moderate part means we probably shouldn't expect, like, crazy explosive jumps.
Yeah.
It suggests something more measured, maybe less speculative, with steady upward pressure, but yet tempered by that mild volatility we mentioned.
Got it. So for someone watching the charts day to day, what are the moments to watch? The inflection points where the price might really pivot or hit a temporary ceiling?
Right, yeah. The report flags a few key moments within this 30-day window. First, there's an early one, maybe in the first week or so, around $121,960.
Okay.
This could act as sort of an initial floor, a support level the price might bounce from. Then, maybe mid-period, second week, look for about $123,440. That might be a local peak, maybe followed by a bit of consolidation.
Breather, maybe?
Could be. And finally, later on, maybe the fourth week, around $126,530. That looks like potential resistance. A level the price might struggle with before trying for that final peak near $128,840. These are the spots where you'd expect more action, maybe shifts in direction.
Makes sense. And beyond those specific turning points, what about the bigger boundaries? The, floors and ceilings, the support and resistance levels the AI says are critical to keep an eye on.
Absolutely. The technical analysis side lays out some pretty clear boundaries. For support, think of these as the floors where buyers might step in. It starts with that initial $118,170 level.
The starting point.
Yeah. Then you've got $121,444 as a mid-period support, and later $123,150. On the flip side, the resistance levels, the ceilings where selling might pick up, are pegged at $123,438 mid-period, $126,530 late period, and then that ultimate high resistance right near the peak, $128,839. The report describes the overall pattern as gradually ascending, moving within these light price channels, basically a fairly narrow, consistent upward path.
So not wild swings necessarily.
Exactly. It suggests more orderly accumulation, not huge volatility spikes. And momentum-wise, it sees it as stable and upward early on, maybe sliding down a bit towards the end as it bumps up against those higher resistance levels.
Okay, and what about the shakeups? How bumpy is this ride expected to be? How volatile? And what does that really mean for you if you're trying to navigate it?
Well, the forecast suggests volatility might actually increase gradually, especially later in the period, precisely because it's hitting those inflection points and resistance levels we talked about. The report highlights weeks 2 and 3 as potentially having the highest volatility, with prices maybe bouncing around more between, say, $123,000 and $126,000. But here's something interesting. It also points out a favorable risk-to-reward ratio, estimated at 1 to 2.
1 to 2. So potential reward is double the potential risk according to the model.
That's the idea based on the AI's calculations. It suggests the potential downside seems smaller than the potential upside within this forecasted range, making it look relatively attractive for those aiming to catch that upward movement.
Now, this is where it gets really interesting for me. These advanced forecasts, they aren't just pulling numbers out of thin air. They're often backed by a lot of on-chain data. What are those metrics telling us about Bitcoin's actual health, its network activity?
This is like looking under the hood of the car. And the on-chain metrics here paint a pretty healthy picture. For instance, transaction volume is high, over 580,000 transactions in 24 hours. That shows strong network use, lots of activity.
People are actually using it.
Definitely. And the network's core health looks robust. You've got a hash rate over 900 exahashes per second, difficulty around 126 terahashes.
And what does that translate to for, the average person?
It means the network is incredibly secure. It's being very actively mined, which shows miners are confident in Bitcoin's future value. It basically reduces security risks significantly. Then look at fees. The average fee is under $4, $3.88, and the mempool size, that's the queue of waiting transactions, is pretty small, under 8,000.
So transactions are going through quickly and cheaply.
Exactly. Which is great for usability. It encourages trading and general network activity. It's a positive feedback loop. And finally, Bitcoin's dominance, almost 62%. That shows a lot of capital is flowing into Bitcoin itself. Although the report does hint that if Bitcoin pushes past $126,000, some money might start rotating into altcoins.
A potential shift there.
Could be. And just the sheer size market cap, over $2.35 trillion, that screams institutional interest. Big money is definitely involved here.
So beyond the hard data, what's the overall mood? What's the sentiment in the market, and how might different types of investors react according to this forecast?
The prediction is for sentiment to gradually shift, maybe from neutral towards more positive. The fear and greed index is expected to be moderate, suggesting confidence is slowly building, not, euphoric yet.
Okay. Cautious optimism, perhaps?
Something like that. And this plays into how different groups might act. For example, the big institutional players, they're likely accumulating, probably buying near those support levels like $118,500, given the volume. Retail investors, though, they tend to react more strongly to the swings. The AI suggests they might get nervous and sell if prices dip below $121,000, but maybe jump back in with enthusiasm if it breaks above $124,000.
So volatility triggers different responses.
Definitely. Which is why keeping an eye on that fear and greed index is so important. It could be a good gauge for potential reversals when sentiment gets too extreme one way or the other.
Okay, so putting this all together, what does it actually mean for your strategy? How can you use this forecast depending on whether you're, say, a long-term holder versus a more active trader?
Right. The report gives some specific ideas. For conservative investors, the thinking is more about holding long-term, maybe looking to add around that $118,000 support level, targeting a potential exit closer to $128,000. But crucially, combining that with diversification and definitely using stop-loss orders, maybe around $118,500, just to protect against unexpected drops. Risk management is key.
That makes sense for the buy and hold crowd. What about moderate investors, people looking for maybe swing trades?
Yeah, for them, the idea could be trading the predicted range, buying near support around $121,000, selling near resistance around $126,000, maybe allocating, say, 20–30% of capital to this. And for this group, paying attention to the fear and greed index could be really useful, maybe entering trades when the index is low, indicating peak fear as a contrarian signal.
And then for the really active folks, the day traders, how can they use this?
Active traders could look at even shorter-term moves, targeting profits at, say, $120,000, $124,000, maybe using a bit of leverage, carefully, of course.
High risk, high reward territory.
Absolutely. Those inflection points we discussed earlier become prime spots for scalping quick profits. But with that comes the need for really tight stop losses, maybe at $119,000, to cut losses quickly if things go wrong. Generally, though, across strategies, the report suggests potential entry points around $118,500, with a stop at $118,000 and an initial target near $124,000. Always managing risk, maybe limiting capital per trade to 5–10%. And for shorter-term trades overall, allocating 10–20% capital and aiming for something like a 1-to-3 risk-reward ratio seems advisable given the expected movements.
It sounds incredibly detailed, almost like a precise roadmap. But realistically, how much faith should you put in an AI forecast like this? What are its real strengths, but also what are the limitations we need to be aware of?
That's maybe the most important question, right? Its reliability isn't uniform across the whole 30 days. For the very near term, say the first week, July 17th to 25th, the report gives it a high reliability, 80%, plus or minus that 5% error margin. That's because the current trends are clear.
Okay, stronger confidence early on.
Exactly. But midterm, weeks 2 and 3, that reliability drops to moderate, around 60% plus or minus 5%. Why? Because potential volatility increases, driven by those on-chain factors, which can shift a bit more unpredictably over a couple of weeks. And then looking further out, after August 1st, the long-term reliability is rated lower, maybe 40% plus or minus 5%.
Why such a drop-off?
Because that's when bigger picture stuff, macroeconomic shifts, major network updates, things the model might not perfectly predict, start to have a much bigger potential impact. You have to remember the limitations.
Yeah.
This AI is primarily crunching technical patterns, historical data. It can't predict, a certain global regulatory crackdown or a massive unexpected economic event, the black swans.
Right, the unknown unknowns.
Precisely. And even those on-chain indicators, while powerful, can change fast.
Yeah.
Plus, Bitcoin doesn't live in a vacuum. Volatility in traditional markets can spill over. So while it's a sophisticated tool giving a potential path, always remember that 5% potential wiggle room, that confidence interval, around all the price points.
So we've just really dug deep into this AI forecast for Bitcoin. We've looked at the price predictions, the on-chain data backing it up, the market mood, even specific strategies all wrapped up in these confidence levels.
Yeah, it really shows how these advanced models can sift through massive amounts of information to offer a possible roadmap. But it also really highlights how crucial it is to understand the why. What does network health really mean? What is sentiment actually signaling?
Absolutely. For you, the listener, I think the big takeaway isn't just memorizing the price targets. It's about getting a feel for that complex web of factors driving the market and how to interpret the signals yourself. So here's a final thought. Even with these incredibly powerful AI tools giving us detailed forecasts, how do you balance that data against things AI can't easily measure, like raw human emotions, sudden world events, or that fickle fear and greed index? What's the essential role left for our own human judgment and critical thinking when we're faced with predictions that are so precise, yet by their nature, incomplete? Something to think about as you navigate the always fascinating world of markets.